No one sells a business without thinking through the terms of the deal, but a lot of business owners don't put the same level of thought into how the sale is structured for tax purposes. And that's where things can get costly. Capital gains tax, GST exemptions, and small business CGT concessions can change the final outcome of your sale if you know how to take full advantage of them. So in this deep dive, I break down how capital gains tax applies to business sales and how to reduce it, the small business tax concessions that can significantly cut your tax bill, asset sale versus share sale, and the key tax considerations that every business owner should factor in before selling. Let's get into it.
Selling a business in Australia is actually one of the most tax-effective ways to minimize your tax. So when you look at your tax rates in Australia, in personal name, it's about 47% if you're making a lot of money on an annual basis. If you make it over 190K, you're paying 47%. When you're making money in a company, you're paying 25%. And when you're making money in a superannuation fund, or a self-managed super fund, when you're investing or whatever it is, it's taxed at 15%. If you do it right and you sell it well, and you look at the tax concessions, you can actually apply tax concessions that reduces the tax to zero. So just want to point that out. If you sell a business for $1 million, for example, and you meet all the tax eligibility requirements for the concessions, they call it small business CGT concessions, as well as like the 12-month discount. You can apply multiple different concessions and you can reduce your taxes to zero. And the crazy thing is that a lot of business owners, a lot of accountants, the local accountants don't really know much about this stuff. They're very good with when it comes to paying taxes and lodging a tax return, paying 25% or paying wages and doing a personal tax return. But when it comes to actually understanding those like special small business concessions, it's actually very confusing. And so as a result, they just make you pay 25% or make you pay 47% with the 50% discount. And that's all they do. And you end up paying a lot of tax. For most business owners, they think it's okay because when they make money, they pay tax and they're quite used to it. But they don't actually understand that there's actually all these special concessions that help you. So today's deep dive is about this. So there are a few things I want to go through. The taxes involved when you sell a business, the way to sell your business. So there's actually methods of selling a business. There's two ways to sell it. And the concessions that you are able to apply for that reduces your tax. Let's start with the tax implications. So when you sell a business, there are two ways to sell. Selling business asset sale and share sale. Okay, I'm just seeing, here it is. Here's an article that talks about selling a business. There's selling a business through shares and selling a business as the assets. And so what's the difference? Most business owners, when they buy a business, they usually buying the assets. They go to a lawyer, they write up a contract, and the contract says, I buy this, like, you're buying this business and you're buying the goodwill, the plant and equipment, and everything listed after the contract. So there's a whole list of assets that they purchase. And then also client book and all that stuff like that. So that's buying a business. But for bigger businesses, for corporate businesses, they don't care about buying the business assets. They want to buy the shares. So what they do there is, for example, say it's Coca-Cola. You just go and buy 100% of all the shares listed. But by doing that, you also acquire the whole business. So a lot of people actually don't know the difference. And that's just the big difference. The big difference is instead of buying the business assets that are internal for the business, you buy the whole business by taking over the shares. So that are the two differences of buying and selling a business. Okay, so what are the implications as a result of that? The tax implications you have when you buy and sell a business, or mainly selling, is income tax. And that's also known as CGT or capital gains tax. All right, let me just zoom in a bit. And goods and services tax. And services, which is also named GST. That's the 10%. So crazy, right? The ATO wants to take 10% of your sale sometimes as well. And then the last thing is stamp duty. Okay. So what is the difference? You would have heard of this before. If you've purchased property or had any transactions through a business, you would have heard of GST as well. So when you're buying and selling a business, these also get involved as well. It's not just about this. A lot of people always just think about capital gains tax and they forget about GST and stamp duty. Okay, the good thing about buying a business or selling a business, they say that if you're buying and selling a business that is a going concern, very fancy word, but all it means is it's like the business is a walk in, walk out. So for example, the new owner walks in and the old owner walks out, which means that basically the business that you're selling or have purchased has absolutely everything that's required to be able to run the business. Has an office, has staff, has contracts already, clients and all that stuff like that. Then that is like a business that you're buying of going concern. So as a result, the great thing about it is GST is exempt. And the way that ATO sees this is that they're trying to encourage people to keep the business running. So if they keep the business running, that means that they don't care about too much about the GST of the business, of the business purchase or sale. They just want the business running so they can collect GST when the business keeps going forward for the next 5 to 10 years. So GST is actually exempt on small businesses sales.
Just on that, when you say the business has an office, is that a must? Are we like talking if it is an online business and has no office?
Yep, that's a good question. So the answer is no, it's not a must. It's not compulsory. But if you're selling a business asset that has like a commercial property, for example, and you're selling that's still selling a business, it's just a commercial property. Obviously, you need the physical place, but they also ask for a tenant to be there. So there has to be like a actual business running. So if there's no tenant there, then they say, well, there's no tenant there. It's not really a business. There's no actual income coming in. Even though it's like a gym, there's no actual gym business there. So therefore, they're going to charge GST. So there's nothing wrong with selling it. All they do is just charge the 10% GST when you purchase the business or when you sell the business. Is that a problem? Not really, because if you're the buyer, you get to claim the 10%. And if you're a seller, you just need to add 10% on your sale and just pay that and remit that to the ATO in the next BAS. So it's not really that big of a problem. The only reason why it's a problem is you have to come up with that 10% to give to the government. That's the hard part. And a lot of banks, if you're trying to borrow money, they discount the purchase and they don't include the 10% GST. They're a bit stingy when it comes to that, but their argument is that GST portion isn't supposed to be part of the business loan. You're going to get that back, like you're going to get that money back as a GST refund when you purchase the business. So therefore, we're not lending you just free money that you get to hold on to. We're lending it for the purchase of the business, not for the GST portion. So GST isn't that big of a deal. I just want to let you guys know that if a business isn't sale of going concern, then definitely you can't claim it. Sale of going concern. It's a very weird term to use, selling of going concern. So basically, it could be a property. A lot of the times it's about property because like commercial properties is a big thing. So like a fully tenanted building, then where the property has all the leases and lease agreements, that means that it's a sale of going concern, which means it's exempt. Selling a business, basically you're selling a hairdressing business and all the stock equipment still there and even the staff, that means sale of going concern. So that means that no GST. However, if you sold a business and all you're selling is, say, the client book or the emails or the customer information, then really you have to add GST on top. All right, so the next thing you need to worry about is stamp duty. So stamp duty is a state tax. New South Wales government, if you're based in New South Wales, is terrible. They just love to tax things and I think it's very inefficient. So stamp duty is a tax that basically based on transactions. So the government, when they just want to verify a transaction, they charge stamp duty. That's what stamp duty is. So back in the day when it comes to like the government and like the councils and state government, they needed to verify transactions to determine that it's legitimate. So usually for property and car purchases and assets, like very significant asset purchases. So you need to buy a asset, and then you go to the to state government, and then they stamp it for you. So all this stuff now is going online. There's not as much physical stamping, but it still happens online. So people still stamp, the government still stamps it, but they just don't physically get a rubber stamp and stamp it. That's where the name came from, stamp duty. So basically all it is they just need to verify the transaction. And that verification of that transaction, they charge 1% to 2%. It's a bit annoying when you're purchasing an asset for $1 million, $2 million or whatever, that they're going to charge 1 to 3 or maybe even up to 5%. It just depends on the asset. So what we try to do is that we try to find concessions in the Stamp Duty Act to be able to exempt the transaction to have any taxes. But that's how it works. Stamp duty is that you go to the lawyers, they verify the transaction. They usually either buy or sell the asset. Could be a property, could be a business property, could be a small business, and they would tell you if there's stamp duty involved. Okay, so the lawyer should be the one that's advising you on stamp duty. A lot of people think that it's accountants, but accountants actually don't deal with stamp duty that much. All we do as accountants is we just take it up as an expense, and we can claim it on your tax returns on the sale of your property or your business. But when it comes to working out what stamp duty is, that's done by the lawyer. There are some concessions that you can apply. So and I'll go more into detail of that. So when you buy and sell a business, remember how I mentioned, guys, there are two ways: asset purchase through contract, and purchase of shares. So they are the two options that you have when buying and selling a business. So I think that both have pros and cons. So obviously buying and selling a business for through assets, you don't actually take 100% of the business and its liabilities. So when you look at the balance sheet of a business, there's assets, there's liabilities, there's liabilities being like bills, tax liabilities, debt, as well as possibly like supplier costs and all that stuff, the creditors. All those you can exclude out of the contract. So what you can include in the contract is the goodwill, stock, equipment, plus, do's and don't do's. Okay, that's just my way of calling, some terms and conditions in the contract. Okay, so that's what normally happens when you're buying a small business. You go to the lawyer, and the lawyer will draft up a contract, and they'll say, okay, $1 million is the purchase price. A portion of that is for goodwill. The rest of it is for stock, equipment, and, customer base or something like that, or customer list. That's how you purchase it. However, the great thing about that is the pros about this is it's easy to do. You don't take over the liabilities, and less risky, because you don't actually know if anything happens or anything's happening with a customer. So they could be having a legal battle with a customer. If you assume control of the shares and 100% of the business, that means that you're liable, the business is liable. Whereas in this situation, could be a con as well, you set up a separate legal entity. So that could be a new company or new trust to own the business. Okay, it could be in your personal name as well. That's a con, but also a pro. So it's a bit of both, it's neutral. And the reason why is because it costs money, you lose the history, you have to pay a bit more money to actually set up another entity. However, it's a good thing as well because you don't actually take on all the risk and the liabilities. You can speak to a lawyer. Lawyers can go through the pros and cons. A lot of lawyers are ones that advise on that. But most general small businesses would actually think about buying the business through asset purchase. And you will see it, guys. Like you'll see a contract and it says contract of sale. And it usually has business, goodwill, and it has like 50 pages. And the reason why it has 50 pages is like the terms and conditions, the do's and don'ts do. Then it has like a schedule of the equipment list, has a schedule of the stock, it has information about the goodwill and intellectual property as well. Cool. You can add extra things in, and you can also add things that prevent them from doing things like non-compete in the contract as well. The bad thing about this is that usually when you're buying a business like that, the entity that you have that owns the business is the one that controls and has the tax benefit. So for example, if you're selling a business through an asset sale, that means that your company is the one that sells it. So I've got a good example here. So this is a very good example of a business structure. Husband and wife. Husband is the controller of the trusted company. Then the family trust controls the business. Okay, so let me just quickly delete this so you guys can see it. Cool. All right, so this is what it looks like. This is how it looks for a normal business. So husband and wife, trustee company with family trust, and the family trust owns the trading company. So what happened is that, let's just say it's a cafe. Cafe decided, I'm going to sell the business and I'm going to sell it for $1 million. They've got two options. One is they sell the business in the trading company. That means that that's getting sold inside. And then where does the capital gain and the stamp duty and GST get applied, as opposed to option, let me write this out. Option 1, sale of asset. And then option 2, sale of shares. So when you sell the shares, there is a capital gain as well, right? But the capital gain doesn't exist in the trading company. It actually exists in the family trust, because the one that's selling the assets is the family trust. Whereas the trading company in option 1, it's a sale of assets. It's actually happening in the actual company itself. So the capital gains happen here. So with option 1, CGT and the taxes are implicated into the company. Whereas option 2, the taxes is happening in the family trust. Okay, there's benefits on both ways. First thing you need to understand is that in capital gains tax scenario, there is no 12-month discount. So if you go to 12-month discount, there's no 12-month discount for a company. So everyone's heard of the 12-month discount. When you own an asset, a property, or a business for more than 12 months and you're an Australian resident, you get a 12-month discount, a 50% discount on your asset. So if you sell it, make a profit, you get to times it by 50%. But the thing that a lot of people forget about is that companies cannot use the CGT discount. They are actually exempt from that. So you can't actually apply the 50% discount. So that means that if you sell a business in here, you're naturally going to pay 25% and you don't get that 50% off. Whereas when you sell in the family trust doesn't pay any taxes, but it has a 50% discount. So sometimes it's actually better to sell it in the family trust and sell the shares rather than selling the asset, because you want to utilize that 50% discount. Wherever you can convince the buyer to buy the shares rather than the business, that's up to you. That's what happens when it comes to capital gains tax. What happens in GST? Quite similar. There's GST. Oh no, sorry, I wouldn't say it's similar, but in option 1, sale of asset, it's a sale of going concern, meaning that you're selling the business and it's a walk in and walk out. That means that GST is exempt. And when you're selling shares, there is no GST on shares, no GST. So option 2, which is the sale of shares, also doesn't have GST on it as well. Okay, what about stamp duty? So when it comes to stamp duty, that's actually a very good question. I'm just asking myself. So I can't remember on the top of my head. I always forget the stamp duty on shares. So there is no stamp duty on shares for New South Wales. So there's no stamp duty here, okay, for sale of shares, but there's a problem for sale of assets. So a lot of people don't know this, but there's actually stamp duty on sale of assets. So plant and equipment you actually have to verify it and register it with the New South Wales government, and there's actually stamp duty on plant and equipment. A good thing though, no stamp duty on goodwill, I believe. So I think it's exempt for goodwill purposes. So stamp duty applies to transfer of physical assets, so property, plant and equipment, and goodwill, however, for New South Wales is exempt. So you don't have to pay stamp duty on that. So like I said before, in the contract, you have a portion for goodwill and portion for plant and equipment. So that $1 million sale could be like, 800K of goodwill and then 200K for plant equipment. And that means your stamp duty bill will be less. But you got to understand that if you do 800K in goodwill, that means that sits in the balance sheet and stays there until you sell the asset and then you can claim it. But plant and equipment, everyone knows what plant and equipment is. It's depreciable. It's a depreciable asset because it's actually a portion that you're utilizing the asset throughout the years. So you get to claim a depreciation even though you bought the business and you spent like $1 million on it. You get to claim a tax deduction for it. So there's actually a benefit of putting a higher portion of plant and equipment. Again, you're supposed to just verify with the seller what portion is for plant and equipment and what portion is for goodwill. And then you just work off that and put that into your accounting system to claim the tax deductions. But that's the different options, guys. So tax-wise, that's how it works. Option 1, sale of an asset, sale of going concern, GST exempt, stamp duty on sale of the asset. There's no CGT discount. However, if you're selling it within the business, you're paying tax of 25%. Whereas in option 2, if you're selling the shares, you're selling a $1 million business, there's no GST on shares. There's no stamp duty on shares as well, share transfers in New South Wales. You also get a 50% discount because you owned it for more than 12 months. One last thing is both situations, you can aim to claim small business CGT concessions. And I'll go into more specific about that, of what it is. So these are the options, and they are the main thing that changes if you're selling it like those ways. Okay, which one is beneficial for the seller and which is beneficial for the buyer? Okay, so I actually have a preference. If I'm selling the business, I actually prefer, as a seller, this is option 2 is pro seller. And then option 1, which is sale of asset, is pro buyer. So the buyer would always prefer to buy the asset and exclude all the liabilities. The seller would always prefer to sell the whole thing at once because they get to claim 50% deduction, still get to claim this. There's no stamp duty, there's no GST. It's a beautiful thing. Yeah, so the taxes are amazing when it comes to selling the shares of a business. And also they can wash their hand clean completely without thinking about the liabilities ever. Okay, sometimes the seller doesn't like selling the shares. And the reason being is because they've got personal assets or other assets in the business or in the company that they want to keep. And so it's a pain in the butt to remove all that. So if they want to sell a portion of the business rather than the whole business, for example, I'm an accountant. I've got a mortgage brokering business as well in the accounting firm. And I just want to sell the mortgage brokering business. I don't want to sell 100% of my shares because it's not what I want to do. So as a result, it's not a good way to sell my business. So I have to use option 1, which is sale of an asset. Pro buyer for sale of purchase of an asset. Why is that a pro buyer? The reason being is because you just want to buy the good stuff in the business. You want the plant and equipment, you want the goodwill, and you want the terms and conditions to prevent the seller from, starting a business next door. Also, you don't need to care about the CGT discount as a buyer because you're not selling anything, you're buying everything. You still get to claim the costs as a tax deduction when you sell your business. So it's actually non-beneficial for you to buy the shares. It's better to buy the asset. And then you can clearly state what you want out of the business as well. So most buyers will prefer option 1, but some buyers would actually prefer option 2. And the main reason why is because they want the history. They usually want to see that this business has been around for 10 to 20 plus years. That means a lot to them. So they can, it could be a marketing thing or a brand thing, or they have these contracts that they can't remove. They can't just switch to another company. So they just buy 100% of the shares. So some buyers actually prefer to buy 100% of the shares. So I actually had a client I was speaking to yesterday about this. So they were running a carpentry renovations and fit out business, right? They signed 3 or 4 contracts with schools and the government. So that means that these contracts, it's like for maintenance purposes. And it's in this company right now. So these contracts are signed under that name, under this trading company, and not under the family trust or anything like that. So when you want to buy that business, you're buying those contracts, and so as a result, you can't just like transfer those contracts over to a new business. There's like legal requirements that you have to meet. You have to re-sign a new contract, and the schools, the government, which are the customers, may not want that. They may not. They prefer just working with that builder or that business. And so as a result, the easy way around this to avoid the customers from being not happy or knowing about the purchase of the business is actually buying the whole thing, buying the shares. So the contracts still stand with the company. It's still around. Yes, the directors change, but the company's still around. The history is still there, and the contracts still apply. So that's why people prefer to buy this. And they don't care about the tax consequences as a result. They got to do their DD really well, due diligence, because if they make a mistake and they find out there's like a $1 million in creditors or debt, and the actual owner that owns the business would also have to deal with that as well. So they'll have to deal with the debt as well. So they have to be very careful of what they purchase. Yeah, so that's the main things of buying and selling.
Just confirming that in both cases, if there's a brand that's going to move to the new owner.
Yes. So both cases can work, because in the sale of an asset, you're writing down exactly what the contracts, what the assets are. So the asset could be the goodwill, the branding, the website, the logos, they all go. Yeah. So that's all listed in the assets. You also even list the plant and equipment, the actual physical assets as well. All right, some things that you need to consider, which is, I think the most meaty part about this is the small business CGT concessions. I'll go through the small business CGT concessions with you. And the next thing after that, I'll explain how to apply it in the example. So let me just, I think my website has the best, sorry, I'm probably talking myself up, but I think my website has the best explanation on how it works. So there are actually two different concessions that you can claim. All right. First one is what I discussed, which was 50% discount. So you can claim the 50% discount on a business that you own for 12 months. Over 12 months, you get to wipe 50% of your profit. And it's amazing. Okay. The second thing that you can do is use the small business CGT concessions. And this is purely on income tax, not for GST, not for stamp duty. We've already discounted that some of these is very easy to get away from if you're just smart about where you structure your purchase, whether you structure through the sale of asset and have more goodwill, or you structure through a purchase or sale of shares and there's no stamp duty and no GST. Okay. And also like it's a sale of going concern where it's a walk in, walk out. Okay. So that's all good. What I'm more focused on is income tax. When it comes to income tax, there's the 50% discount, but what you can do is add on another concession. So in Australia, there's a small business CGT concession. So in Australia, they recognize that people that run businesses, small businesses, their business is their retirement plan. So when they sell their business, they usually have a whole heap of cash, and their super fund is probably not that high because they rather focus on investing in their business their whole life rather than investing in the super fund and collecting 12% of super to pay to their super fund. So most small businesses have a very low super fund balance compared to the general population. So what the ATO and the government has decided is that we should actually invite people to sell their businesses and bring it over to the next generation of business owners. And we should also give them a concession so they don't need to rely on social security. So it's actually beneficial for small businesses to fund their own retirement. So therefore, we shouldn't tax them that much. So that's why they created these small business CGT concessions. However, there are strict eligibility requirements. The first condition you need to meet is you have to be considered a small business entity. That means that your turnover has to be less than 2 mil, or the total value of your total net assets, including all the connected entities and related entities, is less than 6 mil. So it's easy to meet if you plan it, but if you don't think about it too much, then you can easily exceed that situation. So for example, you got a cafe, turns over more than $5 million a year, but you sold a business for 2 mil because it doesn't generate that much profit. It's like, yeah, 5 mil turnover, but profit wise, it only makes, 500K a year. Then that means that you just sold it for $2 million and that's the price that you want. That means that if you add that on, plus your, investment assets, your net assets might be still under 6 mil. Okay. When I say net assets, it also means your liabilities. It also means like your loans, your mortgages that you had to take out. So net asset 6 mil test. It actually excludes your property, your main home as well. So there's a rule that you need to follow. And the ATO website has a pretty clear list of things that you need to add in and exclude. So first things first is you need to include all the CGT assets. So any CGT assets that are connected to you and that are owned by you, and any affiliates and entities connected with your affiliates. So for example, husband and wife, husband controls the wife's assets as well. You can easily, safely say that the wife's assets are the husband's wife assets as well. So there are a list of assets that you have to include. And here's the list. There's CGT assets, depreciable assets. However, there's also a list of liabilities that you need to deduct out of the net assets too. So these are all the list of liabilities you need to deduct. The main thing that you need to understand is it's the creditors, the loans, the mortgages, and business loans and credit cards that you have. That's a liability. Okay, so also assets to exclude. Okay, personal use assets and superannuation assets are excluded. So some people forget that they think they need to add the super fund in it, but you can exclude that out. So a lot of people actually generally don't have over 6 mil in net assets. And so they usually meet this. But be careful, if you sell a business for $2 million, that 2 mil gets added to your 6 mil net asset test. So it's your 2 mil plus investment properties minus your loans, minus your credit card, plus cash at bank, savings. And that's the general rule of how to work out the 6 mil net asset test. Turnover is very easy. Remember, it's like this test or the other. So some people don't meet the $2 million turnover test. So you go with the 6 mil. 2 mil is very simple. I think it's like the present year or the last year or the current year that's going. If it's less than 2 mil, if it's less than 2 mil aggregated income for all your businesses, then you meet the eligibility requirement for number 1. But you also need to determine that the asset that you're selling is also active. What does that mean? Active means that the asset's actually used for business. So if you're selling a website that's worth $1 million, that's actually used for the business, that's active. The ATO suggests it has a clear rule of active asset because sometimes an asset could be active and used for business, not for the full lifetime of it. So they actually go into detail about asset tests as well, active asset tests. And basically what they say is that for half of the lifetime of the test period, which is the lifetime that you own the asset, it has to be considered active. So for example, they've got a good example here. Jody ran a florist from a shop she owned for 8 years. She ran the business for 5 years. She then leased the shop to an unrelated party for 3 years before selling it. So what period is it active? It's active for 5 years because she ran the shop for 5 years out of the 8. So therefore it passes the active asset test because more than half of it is active. So the shop meets the active test because it's actively used in Jody's business for more than half the period of ownership. However, if this period was like 3 years and this was 5 years, it was leased for 5 years, then that asset is not active. Okay, so that's how they determine active. Okay, one thing that you need to pay attention to is this one's very easy to determine that the sale of assets is active. But for eligibility condition for 1 and 2, so these conditions here, which is small business entity and active asset test. The active asset test is very hard to meet when it comes to you selling a business in a family trust. The sale of the shares. So if the family trust owns the shares of the trading company, how do you determine that the shares, the 100% ordinary shares that you're holding, is active? So it's funny, the ATO has a rule about that too. So if you're selling shares in a business, you have to satisfy the 80% active asset test. This test here is very confusing, but what they do is they basically look at the small business balance sheet. So let me just find a balance sheet for a small business for you. Yeah, here's a good example of a balance sheet, right? So this is a balance sheet that shows cash, accounts receivable, inventory, prepaid expenses, short-term investments, long-term investments, plant and equipment, and intangible assets and all that stuff like that. So the total assets that is owned in this balance sheet is 200K, right? Prior year, 166, but let's just focus on this year. How do we determine that 80% of these assets are active? So the active asset test for shares, when you're selling shares, you need to determine that shares in the company of an Australian resident, at the time that you own them, the CGT purpose for the income in which you own that interest can be active if they meet the 80% test. The test is met if the market value of the company or the trust active assets and cash make up at least 80% of the market value of the company's trust assets. Okay, sorry, made it very confusing, but the easiest way to say this is that 80% of the total assets are actually used for business. And you need to determine that for more than half of the lifetime of it. So let's say that this business has been around for 2 years, all right? Last year and this year. They've got 200K of active asset, total 200K of assets and 166K of business assets. What is actually related to the business and used for business and what isn't? So I can clearly see here that this cash here is used for business. It's like working capital. The accounts receivable used for business. It's like the invoices for the business. Inventory used for business because they sell inventory. Prepaid expenses, expenses for the business. So that's also active. Short-term investments, maybe not. Okay, short-term investments and long-term investments are investments. If it's related to the business investment, it's considered business. But if it is, for example, a director loan, you're lending money to a director, or you're lending money to another company, or you've invested in shares of Coca-Cola that have nothing to do with your business, technically those short-term investments and those long-term investments are not active assets. So therefore, these need to be excluded out of your active asset test. So 15K and 45K. Let's continue throughout this thing and then do the maths. These are excluded. This is excluded. Plant and equipment used for business, claimable. However, if you have like a personal asset in there, the ATO might just go, well, that's a personal asset. It shouldn't be included. So you got to be careful with all the assets. Intangible assets, that's the website. So most likely it'll be included. Your deferred income tax is related to the business, also included. Other, maybe, maybe not. It just depends on what that other is. So let's go back to the drawing board and let's do this the calculation in this case. And I just want to quickly show you this because this is one of the hardest things to do. And a lot of businesses don't know how to do this. So I want to show you because half of you guys are accountants. 200K, 203,200 is the total assets. And then we've got the net assets, active assets. So the active assets is the amount of 203,200 minus the non-active assets. So 15,000, which is this short-term investment, also minus 45,000. Okay. Then you do this divided by that, and you got 70%. Okay. Let's try. That's the current year. Let's try the prior year. Prior year, we've got 166,950. And let me just put 166,950 as well. And then minus 12,000 short-term investment minus 37,500. Okay. So both of the situations, they did not meet the active asset test. So you got to be very careful when you're having all this money in the bank account and you're knowing that you're going to sell one day. You sometimes don't want to invest all your money in that company. on like non-business related assets when you're coming to sell, because it causes issues. If you want to sell the shares one day, it's a problem. But if it's not a problem, if you're planning to just sell the business through a sale of assets, you don't need to worry about that. The only downfall of that is that you don't get the 50% discount. All that explaining of like the eligibility requirements, I actually haven't told you the benefit of a small business CGT concessions. So I should have started with that, because that actually means you guys would get excited about it. But right now, like, I'm just telling you if you're eligible or not, and it doesn't really tell you how exciting it is. So let me go straight into that. So there are 4 concessions with the CGT small business concessions. The first one is the 15-year exemption. This is amazing, this rule. Basically means that if you own the business for more than 15 years or the asset related to the business, you can totally exempt that from tax. The entire capital gain can be exempt, but the business has to be owned for more than 15 years, and you must be at least 55 years old or permanently incapacitated. Not everyone meets this situation. Even myself, I've been in business for, I think it's 9th or 10th year now, and I still don't meet this requirement. The other 4 options, so remember, small business CGT concessions have 4 concessions. So it's the small business 15-year rule, the small business active asset reduction, 50%, small business retirement exemption, and the small business rollover. All of these can be used together or separately. So the small business 15-year exemption, you don't need to use any of the other ones. Most of the time when you choose this one, you exempt the whole capital gain, then it's perfect. On this one, you get a further 50% off. So you get the 12-month discount, and then you get a further 50% discount if you meet the rules. And then here is, you can use this active asset reduction, 12-month discount reduction as well, and the small business retirement exemption at the same time, or like together. What happens here is the small business retirement exemption gives you the ability to, whatever's left over as a profit, you can roll that money into the super fund, and you can exempt the tax that you need to pay. But you don't need to roll the full sale price into retirement. You only need to roll the net capital gain after the deductions, after the 50% off and all that stuff. So that's the beauty of that. And then the last one is, if you don't want to use the retirement exemption, you can also just sell your business, claim the asset reductions, and then the leftover amount that you had to pay tax on, you can use that amount to buy another small business in that entity. So that sounds very confusing, but they are the 4 concessions. So let's apply the concessions in this case here. Let's go down a level and just say the business is 400K, because it's just easier to work with rather than 1 mil. Oh no, actually, let's start with 1 mil. Let's do 1 mil. So I'm going to get rid of these. Actually, I might just redo another line. Okay. I'll redo another page. So in this case here, the first thing you need to understand is when you sell a business, there's option 1 or option 2. All right. Option 1 is you're selling the business in the shares, and option 2, you're selling a business through the business asset sale. The problem with the business asset sale, like I said, you don't get the 12-month discount. So just understand that part. But let's start with option 1. Say you sell the shares of the business through the family trust. You sold it for $1 million. You get to use the 15% discount to reduce your net capital gain to 500K. And remember, this $1 million, I'm assuming that you spent $0 to buy the business. If you purchase the business for X amount of dollars, you could like reduce your net capital gain at the very start. But I'm just assuming that when you purchase the business, it was $0. So you set it up from scratch and you're selling it for 1 mil. Okay. So that's how the net capital gain is calculated. So first things first, 50% discount, 12-month discount, own the business for more than 12 months, you get a 50% discount. Now your net capital gain goes down to 500K. Next thing is the active asset. I've already assumed that they are not eligible for the 15-year exemption, but if they were eligible for the 15-year exemption, what happens is it's just a minus $1 million, and it just takes that out of the equation completely. This is the 15-year exemption like that, and you don't pay no tax. Absolutely amazing scenario to be in, but you have to be over 55, and you have to have owned the business more than 15 years. And you have to also meet all those other requirements, the eligibility requirements, the 2 mil turnover or 6 mil net asset, and the active asset test. And not as easy to hit as you think it is. So the next portion is 50% active asset test. So you claim that. So your 500K that you've already reduced goes down to 250. So your capital gain, you've made $1 million, but I've been able to reduce it down to 250. So 250K is the leftover net capital gain you pay tax on. So you can either just pay the tax on it, which is, I assume, say 50%. And so therefore you pay 125K on it. So when you do the maths, 125K over $1 million, you're paying 12% in taxes. Probably one of the lowest you would even get. Better than the super fund. The super fund will be taxed at 15%. But you can take it even further using the other concessions. The other concessions you have is small business retirement or small business rollover. So the net capital gain you have left over is 250K. If you really, really wanted to, you could actually put that 250K into super if you're under 55, or you could buy a business. So let me just quickly go over the small business retirement exemption. So you have a lifetime value of 500K to put into super. You have to obviously meet the requirements, but the downfall about that is I believe you have to be, if you're under 55, you have to actually put the money in. If you're over 55, you have to retire. An individual is over 55, they have to, and they're choosing the retirement exemption. I believe that's okay, but you just have to prove that you're retiring. I don't know what the rules are of like, how do you consider yourself retired? But if you're selling a business and you don't own a business anymore, that kind of is pretty much a retirement. And I think there's not much to meet over that. The main rule that you need to be is that you have to be over 55. If you're over 55, you don't need to put the money into super, but you might want to. The benefit of having the money in super is amazing because it's tax-free. If you keep the money in your personal name and you invest with it, then you end up getting taxed more, like in your personal name. If you decide to put 250K into super or invest, what happens? The whole capital gain gets wiped out. So what do you pay in taxes? 0%. So that's with option one, selling the shares for $1 million and you meet all the eligibility requirements. Option two is a bit different. It's you selling the business for $1 million. If you're selling the business, I've actually done this scenario for a client, and I worked out the client actually bought the business within the company for 170K, but let me just remove that. That's a different scenario. In this case here, the net profit of the business is $1 million, okay? Let's assume, like I said, that the business was purchased for nothing and it was like that originally. So net profit is $1 million. Bought the business for $0, set it up from scratch. You don't get the 50% discount. However, you get an active asset reduction. And then you also get to roll over that money into retirement or into a new business. However, the only downfall of this is that it's 500K rather than 250K. But you still can result to paying barely any in taxes. Initially, when I did this calculation, I've taken consideration that the tax is 50%, all right? 50% being 47, I just rounded it up. So that there is, it's just that 250, it's 125,000. In this case here, the company tax rate is actually lower than a personal tax rate. So when a family trust gets the tax, you actually have to distribute the money to the husband or wife. And when you do that, that means that it's going to be 47%, especially when the gain is like 250K, assuming that they're already at the highest tax bracket. So they're paying 50, close to 50% on that 250K if they decide to pay the tax. In option two, if they decide to pay the tax, they pay the tax in the company. So you can actually get taxed at 25% of the leftover amount, which is 500K. So if you did 25% of 500K, the tax is only 125. So when you look at that and compare the options, it's not that far off. The taxes are very similar. So buying and selling a business through a family trust or through a company results the same situation. I also went to the client and I said, however, you got to determine which one's better depending on your options. So I said there are 3 options that you need to understand. That when you sell a business, that $1 million, you need to tell me what you do with that money. That's the very important thing. Okay, us accountants is that we always care about the taxes, but we don't actually ask the client, what do they want to do with the money? Because that really matters. So if they want to take the money out and they want to buy a personal home, they want to buy personal assets, they want to buy a Lamborghini or a boat, that means the money needs to fall in their personal name because they're buying that in their personal name. If they want to invest the money, then that's when they could put the money in a company or a trust. And now advice should change. So option 1, perfect for having the money fall in their personal name. Option 2, where does the profit and the cash sit? It sits in the company. And so the money is still stuck in the company, and that's the problem. So sure, I saved them more taxes, but did I help them get the money out? Because when you take that money out, what happens? When you take that money out, you still have to pay a dividend. And what happens is the dividend still gets taxed. Just be careful, guys, as I'm talking to the accountants out there, that option 2 is not that beneficial if you're planning to buy a personal asset, if the client is planning to buy a personal asset. Option 1 and 2 is useful for scenario. I should change this. Scenario 1 and scenario 3. It's the same amount of taxes, but the only issue is that money still gets stuck in the company. Whereas this case, it's stuck in the family trust. But when we distribute the profits, we actually give it to the individual. We have to pass it over to the individual. They get the 50% discount. They get the 50% active asset test, asset reduction. They also get to roll the money into super, or they decide to buy another asset within 2 years. If they don't do that, they just pay taxes of 125K and then see you later. The rest of the money, which is this minus this, stays in the personal names bank account. And perfect. They can do whatever they want with it, which is scenario 2. They can buy a personal home, they can upgrade their house, taxes being paid for it. However, option 2 is a problem because option 2, all the money stays here, and it's worst case scenario. What would happen is, yes, they pay the lowest tax, but if they wanted to take the money out, they can't buy a personal home with their trading company. They can, but it's painful for tax purposes, and they can't. It's a bit of a struggle to buy a personal boat in a company as well. You should not buy luxury assets in your company. You should buy it in your personal name. So as a result, if they take the money out, it could result to them having to pay the 50% tax in the money they take out again, because they have to declare a dividend, unfranked dividend, or whatever it is. Okay, there are special ways to take that money out, but you have to close the company down. I want to go into specifics of that, but you just need to understand the benefits of one of the other. The first thing we need to do when we're accountants, we need to ask the client, what scenario do you like most? What do you want to do with this $1 million? And then from there, we advise them which option is best for them. And then from there, they talk to the vendor, the seller, the buyer, and then determine if they can actually buy or sell the business based on selling the shares or selling the assets. One thing I just want to note, let you guys know is that when you sell a business, that there are a few things you need to take note of. Usually when you sell a business, there are employee entitlements. So you got to understand that in your contract, and you got to speak to a lawyer. If you speak to a really good lawyer, that will make sure that they include these things. But the seller must settle outstanding employee obligations. So like wages, super, even leave entitlements, that must be settled. Some business owners would just pass that over to the new buyer, and then they'll have an adjustment in the end. So let's say that some employees have long service leave and they haven't taken it yet. They will just deduct that out of the sale price. There's also non-asset payments that you have to deal with. So sometimes, like for example, if I'm selling my business, the buyer might say that, hey, for the next 12 months or 24 months, you're not allowed to trade as an accountant within the 25-kilometer radius. If someone puts that in the terms and conditions, that means that I have to let go of future income. Just be sure that if you're doing something like that, you need to put a value on that. That's important for a lot of business owners. So yes, sure, you're getting $1 million. That may be 3 times the value of the net profit or what the business is earning. Like you're getting a 3 times an EBITDA. However, if they put a term where it says non-compete and you can't actually trade and you're losing like future income for the next 2 years, I think there should be a higher EBITDA, or there should be a higher amount to cover for that non-compete or restraint. So understand that non-asset payments are actually quite a norm, and you should think about that when you're buying or selling a business. And for the accountants out there, you need to advise the client. Same goes to the lawyers. Also, when you're buying and selling a business, accountants and clients always get asked by the lawyer, you're buying the assets or you're selling the assets, what portion do you want as goodwill and what portion do you want for plant and equipment? I did already explain it, but the benefit of having plant and equipment is depreciation. The benefit of goodwill, no stamp duty. The best thing as accountants, they should advise the clients is actually work out what the breakdown is. What is the total value of the plant equipment in the business? So if you're buying a gym, for example, what's the asset market values? So add that all up, do a stock take, add all the assets up together, add all the stock that the business has, and then that's your plant and equipment. That's the value of the plant and equipment. The rest of it is goodwill. So for example, you buy a business for $1 million and you find that when you add all the equipment up, it's 500K. So the equipment and the stock is 500K. So plant equipment is 500K and the goodwill will be 500K. Yeah, that's how you work backwards to work out what goodwill and stock and plus plant equipment is. Also, when you're doing the sale of a business, check if you're eligible for the small business CGT concessions. Speak to an accountant so you get the best advice. You need to also account for other expenses when you're selling a business. Lawyer fees, consultants, valuation fees, marketing costs, sales commission. All those expenses that you pay when you sell a business gets added to the cost base. So you know how when I did the calculation at $1 million, those expenses that you paid actually would reduce the $1 million profit that you'll be making when you sell a business. It won't be $1 million, it might be $950K because $50,000 of legal fees, consultants, marketing fees, and sales commission as well. One last thing is that a lot of people sell a business and then speak to an accountant like after the sale of the business. You should never do that. What you should be doing is speaking to an accountant and a lawyer as quick as possible. If your accountant is not really advising you and just saying, oh, it's all good, then get a second opinion because it really matters. If you sell a business and you don't really consider the small business capital gain, then you could lose out on deductions. You end up paying taxes as a result. And it's too late for you to roll money into super, which could reduce your taxes. And you don't actually need to just use the small business CGT concessions. You can also just come up with more tax deductions to be able to reduce your profits, to pay less taxes. For example, super contributions. If a client hasn't paid their super for a very long time, they get to roll up 5 years worth of super contributions that they have not used up yet and pay it to the super fund and claim a tax deduction for it. So they can get like a portion of that sale and claim as a tax deduction by putting it into super, and it's amazing for them. But you can't do that if the financial year is ended and the sale has already happened. So those are the things that you need to think about when selling the business.
If I'm selling my business to an overseas buyer,
Yep.
will that impact me in any way or shape?
I don't think there is any issues if you're selling to an overseas party. Obviously, you need a contract. Obviously, you need lawyers. Still be the same situation. You just need to make sure the money actually comes to the bank account. Taxes wise, you're withholding 10% GST if you need to. Sometimes the lawyers would say that you need to withhold a portion for tax purposes. But like I said, the lawyers would take care of that part anyway if it's GST. So it should be fine. I don't see that being a problem at all. Yeah. Cool.
Yeah, just a very quick one related to it. If that actually buyer is myself, let's say I have a business overseas, I'm kind of transferring my business overseas. Will that change the situation?
You're transferring the business that's originated from overseas in another entity to yourself?
Originated in Australia.
Yeah.
Let's say I decided, oh, I'm moving to Dubai or moving to whatever place.
Yes.
And I want to kind of move my business. Is the best ways to sell it or?
It depends. Like there are tax incentives of selling it. But just understand that when you sell the business in Australia over to another entity in another country, that means that you're making a capital gain. So we got to go through all these processes. If you just close the business down, there's no capital gain. You don't have to pay taxes. You're creating a capital gain, versus non-creating a capital gain by closing down a business. It could be beneficial for you to create a capital gain, but for tax purposes, but it just depends on the situation. Some people just refer to lift the cost base of the purchase of the business. So what do I mean by that is say that the business is worth, 500K, and you could either decide to close it down or you can sell it for 500K. Do a valuation on a business, sell it for 500K, use the small business CGT concessions, get it down. Okay, so that's one scenario where you don't pay any taxes. And then over there in that country, you've noted down that now you've bought a business for 500K. Okay, this all has to be legitimate and it has to be right. Like it makes sense and the valuation has to be right. But now, for future sake, if you ever sell out business for $2 million, you don't pay tax on 2 mil. You pay tax on 1.5 mil because the 500K deducts it. Again, I'm not an accountant in that jurisdiction. They might even say that there's no tax on capital gains and you don't have to worry about it. But that's kind of sometimes an example where it's beneficial for you to sell it to another entity. Sometimes it's just better just to close the business down. It's up to you.
Awesome.
Cool. Perfect. All right. Anyone have any more questions or everyone's good? No? All right. Thanks, guys. I'll speak to you later.